Around 1,300 miles from China lies Tokyo's Imperial Palace. It covers just 1.31 square miles, yet in the 1980s, it was worth more than the entire real estate in California. Practically, it made no sense, but that's what a bubble looks like. In 1991, the total value of Japanese real estate was estimated to be around $20 trillion, 5 times that of the entire US. At that time, real estate and construction made up roughly a quarter of the economy, and people thought it would last forever. But bubbles rarely do. Because when the bubble burst, land prices crashed up to 80%. Banks were buried in under over $1 trillion in bad loans. Unemployment peaked, and Japan slid into a recession that lasted nearly 25 years. The collapse wasn't an exception, but a pattern, because history repeats itself. Only the countries change, and so does the brutality of each version. When I look at China, it didn't remind me of Japan. 3 blunders made it even worse. Now, the Chinese bots are going to try to downvote videos like this that expose them, but you can help us by clicking on the like button. Thank you. For nearly 3 decades, China's real estate market was nothing short of a miracle machine. After the government privatized housing back in 1998, cities exploded with new construction, millions moved from rural areas to gleaming urban centers, and ordinary families saw their wealth multiply just by owning an apartment. This wasn't just a housing boom. This was the driving force behind China's rise to superpower status. By 2021, the numbers were almost too big to comprehend. Real estate and everything connected to it, the steel mills, the cement factories, furniture makers, banks, and construction companies, made up 25 to 30% of China's entire GDP. But here's the crazy part. The average Chinese household had 60 to 70% of their life savings tied up in property, more than double what Americans keep in real estate. Local governments were even more dependent, pulling in 40% of their revenue just from selling land rights to developers. But in 2021, one of the ticking time bombs exploded. This was the Evergrande crisis. People thought the crisis started in 2021, but the reality was anyone working in the sector could have easily identified what was about to happen, because the entire sector was running a scam, but a legal scam. Chinese property developers had been running what was essentially a legal pyramid scheme. They would sell apartments that didn't exist yet, pocket that cash, use it to buy more land, and then repeat the cycle endlessly. But the only problem with this model was that it worked as long as the prices kept climbing and the banks kept lending, which meant developers were drowning in debt, but nobody cared because the music was still playing. But the Chinese government finally decided enough was enough. In August of 2020, they came up with something called the 3 Red Lines policy. That single thing stripped everyone. The People's Bank of China and the Housing Ministry came down hard with 3 strict financial rules that developers had to follow or else they would face the consequences. First, the asset-to-liability ratio must be greater than 70%. Second, net debt-to-equity ratio must be less than 100%. Third, cash-to-short-term borrowings ratio must be less than 1. In very simple language, for every $100 worth of property a company owns, it shouldn't owe more than $70. Its total debt should not be more than what it actually owns. Third, the company must have enough cash in hand to pay off the loans due within the next year. But this was the oxygen for most real estate companies. China cut that off, and the entire real estate machine froze overnight. The results? No new loans, no bonds, no lifeline. The government wanted to force these companies to clean up their act and stop gambling with borrowed money. This, on paper, made a hell of a lot of sense. But the reality kinda killed the industry. Or I would say this was bound to happen anyways. Foreign investors stopped lending to Chinese developers completely. Chinese banks became paranoid and would only lend to state-owned companies or projects the government specifically approved on what they called a whitelist. The government successfully burst the bubble. But now, nobody wanted to provide the money needed to keep the industry alive. Everyone either blamed the government or the companies. But in reality, the culprit was the greater fools theory that messed everything up. When home prices started their relentless slide in 2022 and just kept going down through 2025, something critical broke in the Chinese investment mindset. For decades, buying property was considered the smartest move you could make with your money. But now, that entire logic was crumbling. Renting out an apartment in China's biggest cities was yielding less than 2%. But this made no sense for buyers, because safer government bonds paid as much or more with zero effort. But the real damage came from the second blow. Property prices themselves were falling. Investors weren't just earning poor returns, they were losing money on 2 fronts at the same time. For a very long time, people were buying overpriced assets, not because they're valuable, but because they believed someone else would buy it from them later at a higher price. In finance, this madness has a name, the greater fool theory. So, did the Chinese realize their mistake? Yes, but did they completely stop buying property? no, they didn't. Not because they were fools, but because they had high hopes from the legend of real estate. While the entire industry fell apart, the damaged legend was still standing tall. It was named Vanka Company Limited. Except the top insiders, everyone believed the company was too great to collapse. They had good reasons to believe this. For years, Vanka was held up as the gold standard of responsible management in the industry, the one developer that investors could trust even when everything else was falling apart. 3 reasons made it the darling of the industry. It had significant backing from Shenzhen Metro Group, a state-owned entity holding around 30% of the company. This fact alone gave it a lot of credibility. Second, unlike peers such as Evergrande, it avoided extreme leverage. Lastly, it focused on steady cash flow, faster project turnover, and disciplined borrowing. So Vanka seemed to have an invisible shield, protecting it from the chaos consuming its competitors. So if Evergrande represented everything reckless and over-leveraged about China's property boom, then China Vanka was supposed to be the complete opposite, the safe bet, the company that did everything right. It was a shield against the chaos. A shield with cracks only the few noticed. Throughout most of 2024, Vanka had managed to weather the storm better than almost anyone else, still accessing credit when others were being shut out completely. But by the final quarter of 2025, the cracks that had been forming beneath the surface suddenly burst wide open. The company was drowning in falling sales, and they had a massive wave of debt payments coming due that they simply couldn't handle anymore. Yet, even at this point, the world was still unaware of the crisis. They only knew when Vanka themselves signaled their downfall. Well, that sounds crazy. Why would someone announce their downfall, right? The simple answer is because they had no option. It was an announcement that changed everything. In late November of 2025, Vanka dropped a bombshell, asking bondholders for permission to delay repaying a 2 billion yuan bond, worth about $283 million, that was due on December 15th. They wanted to push the entire payment, both the principal and the interest, back by a full year by 2026. This wasn't some obscure offshore instrument either. This was a domestic bond that Chinese investors held, and it was the first time in the company's history that Vanka had ever missed a payment deadline. What made this crisis even more alarming was how fast Vanka's cash position had deteriorated. By the end of June of 2025, the company reportedly had 69 billion yuan in available cash, but by the end of September, that number had dropped to 60 billion. And a huge chunk of that remaining cash wasn't even accessible, because it was locked up in project-level escrow accounts, money from pre-sales that legally couldn't be touched for debt repayment at the corporate level. S&P Global Ratings warned that Vanka was facing a sizable maturity wall of bonds coming due, while their operating cash flow was expected to turn negative. The real panic kicked in the moment this news went public. When the news broke, Vanka's bonds went into free fall. A yuan bond due in March 2027 that had been trading at 85 cents on the yuan just days earlier crashed to 40 cents by November 2025. The company's Hong Kong-listed stock plunged to a record low, and its Shenzhen-listed shares dropped to levels not seen since 2008. The Shenzhen Stock Exchange had suspended trading in 7 of Vanka's exchange-traded bonds because the sell-off was so severe. Offshore dollar bonds fared even worse, with a November 2027 bond collapsing from around 55 cents on the dollar to just 23 cents in a matter of days. But another monster complemented the fall. By October of 2025, China's new home prices were falling at the fastest monthly pace in an entire year, proving that demand in the property sector remained devastatingly weak despite countless government promises to stabilize the market. Remember Evergrande's fall? Its spectacular implosion back in September of 2021, when it missed $131 million in coupon payments and turned China's property crisis into a global headline. President Xi Jinping's government had pledged over and over again to fix the problem, but the solutions kept falling short, and an industry that once generated a third of China's entire GDP kept hemorrhaging value. Hopes were fading, numbers were collapsing, and everything looked all doom and gloom until the magic moment finally arrived in September of 2024. That month, the government stepped in with support measures, cutting mortgage rates, easing buying rules, and pushing banks to lend to select projects. This briefly slowed the fall and made it seem like the property market was stabilizing. It gave buyers and developers a moment to breathe, but the relief didn't last. By October of 2025, sales from the top 100 developers crashed 41.9% compared to the year before, falling to just 253 billion yuan. It's the steepest drop we'd seen in months. And it's telling us something important. Those easing measures the government tried, they're not working. If you zoom out a bit to the bigger picture, you'll notice that throughout 2024, new housing sales nationwide totaled 814.5 million square meters. That's down 14% from the previous year. But here's the thing, this isn't a sudden crisis. We've been watching this slow-motion collapse for years. Back in 2021, sales dropped 25.77%. Then in 2022, another 17.3% decline. The trend is unmistakable. They are accelerating downward. Early 2025 gave them a false sense of hope. The first quarter showed sales of about 185 billion square meters, only down 2.43%, practically flat, right? People thought, oh, maybe we turned a corner. By mid-year, the first half totaled 383.6 million square meters, down just 4.4%, with total sales valuing at nearly 3.9 trillion yuan. But July came along and crushed that optimism. Sale values plunged 24% year-on-year to 211 billion yuan. And mind you, it dropped a whopping 38% from June alone. And experts are here with some bad news, and second bad news. Experts are predicting home prices will fall 3.7% for all of 2025. And second, they are not expecting any relief in 2026 either. We're not looking at stability until 2027 at the earliest. In October, new home prices across 70 major cities dropped 2.2% from the previous year, which actually sounds like good news because it's the slowest decline since March of 2024. But look at the monthly numbers. Prices fell 0.5% from September to October, the sharpest monthly drop in a year. June was particularly brutal with a 0.3% month-on-month decline, the fastest we'd seen in 8 months, and a 3.2% annual drop. By the second quarter, when you factor in inflation, real prices were down 6.38%. Here's where it gets weird though. In November, new home prices actually ticked up 0.37% from the previous month. That sounds positive, right? Except resale prices, the secondary market, plummeted 0.94%. The market is literally splitting in two, with resale markets showing zero confidence. There's one bright spot in all of this darkness: Shanghai. It's the only Tier 1 city still growing, with prices up 5.7% annually in October and a remarkable 10.10% year-on-year increase in new homes back in March. But Shanghai is the exception that proves the rule. The real nightmare is what's sitting unsold. By the end of August 2025, there were approximately 762 million square meters of completed housing just sitting there, empty. That's up from 7.53 million at the end of 2024. By March, residential inventory available for sale had climbed to 421.58 million square meters. The inventory turnover ratio, basically how long it takes to sell everything, has improved slightly to about 21 months from its peak of nearly 26 months back in April. But that's still almost 2 years of unsold homes just piling up. And here's the scariest part. There's hidden inventory that we're not even talking about. When you look at the gap between what developers planned to build and what they actually sold, there's approximately 6.6 billion square meters lurking in the shadows across the entire market. China's Vanka is sitting on 364.3 billion yuan in total interest-bearing debt. And while Shenzhen Metro Group agreed this month to provide emergency loans of up to 22 billion yuan in the first half of 2026, that might just be delaying the inevitable. Financial reports suggest that Beijing had given preliminary guidance to Shenzhen's local government to consider a market-oriented approach for dealing with Vanka's debt, which is essentially bureaucratic code for letting the chips fall where they may without a massive government bailout. The fear now spreading through the market is contagion. If Vanka goes down, other developers are going to find it even harder to secure refinancing, and the selling pressure in the housing market could accelerate dramatically, dragging prices down even faster than they're already falling. When Vanka's distress signal went out, the market didn't just react badly, it went into total panic mode, and the damage spread way beyond just one company. Within days, Vanka went from being a safe bet everyone trusted to looking like it might not survive the year. S&P Global Ratings basically delivered the final verdict in late November when they absolutely destroyed Vanka's credit rating, dropping it all the way to CCC-. That's not just bad, that's catastrophic. It's the rating you get when the analysts think you're probably going to default within 6 months. They slapped on something called credit watch with negative implications, and didn't mince words, saying Vanka's financial situation was unsustainable and the company was running out of money fast. What happened next was pure chaos. The day Vanka announced they couldn't pay that bond on time, 6 of their bonds got absolutely destroyed, losing more than 10% of their value in hours. One bond was so bad it dropped 32% in a single trading session, and the stock exchange actually had to stop trading just to prevent complete meltdown. Over in international markets, Vanka's dollar bonds that were supposed to be paid back in 2027 were changing hands for just 20 cents on the dollar, which tells you everything you need to know. Foreign investors had given up hope on getting their money back. The company's stock was in freefall too, with shares in Hong Kong hitting the lowest price in the company's entire history, while the Shenzhen shares crashed back to where they were during the 2008 financial crisis. But here's what really sent chills down everyone's spine. At least 2 major Chinese banks turned down Vanka's pleas for emergency loans to cover those December payments. And this is huge, because Beijing has been putting massive pressure on banks to keep lending to property developers no matter what. If banks are so terrified of Vanka's finances that they're willing to defy government pressure and refuse to lend even to a company with state backing, then you know the situation is beyond saving. Turns out that safety net had some pretty big holes in it. Sure, Shenzhen Metro had thrown Vanka a lifeline early in 2025 with loans worth over 30 billion yuan, and sure, they said all the right things publicly about supporting the company, but by the end of the year, something had shifted. They started attaching way more conditions to any new money, demanding tighter guarantees and better terms before they'd consider helping again. The real wake-up call came when everyone found out that Vanka had to hand over its crown jewel, a 57% stake in Unsold, the property management business that was making good money, just to get those loans from Shenzhen Metro. That's not a rescue mission, that's a pawn shop transaction. And it proved that even government-backed support comes with a price tag and hard limits. So where does all this leave China's property market as we move through 2025? Well, the chaos has kind of settled into this ugly, grinding decline that just keeps getting worse no matter what anyone tries. The government loosened some rules in the biggest cities, hoping that rich people would start buying luxury apartments again. And that has helped a little bit at the very top of the market, but this is the tiniest part of the reality. But what really shows you how scared these companies are is looking at new construction starts, because that tells you whether developers think there's any future in this business at all. Those numbers have been in freefall, down almost a quarter in 2024, and then another 20% drop in early 2025. Developers have essentially stopped buying new projects completely because they can't see how they'd ever make enough money on them, and they're too focused on just surviving another month. What makes this even more devastating is that they can't even finish the buildings they've already started, the ones where families have already handed over their entire life savings as down payments. The government has been absolutely screaming at these companies to complete those homes because they're terrified of riots, but completion still dropped almost 15% in the first half of 2025. Why? Because the developers are so broke, they can't even pay the construction workers anymore, even with the government officials breathing down their necks. By October, they were claiming they had approved loans worth over 7 trillion yuan for these whitelist projects, supposedly enough to finish millions of apartments. Sounds incredible on the surface, but when you dig into what actually happened, the picture gets murkier fast. First off, approved doesn't mean the money actually went anywhere. Agricultural Bank of China admitted they had only handed out about 75% of what they approved in the middle of 2025. Then some smart analysts at Trivium China caught something really suspicious. The government kept announcing these huge jumps in approved loans, going from 4 trillion to 7 trillion. But when you looked at the actual credit data showing the money moving to developers, those numbers barely moved at all. What probably happened was banks were just taking existing loans and slapping a whitelist label on them to make their bosses in Beijing happy, not actually creating tons of new lending. But you know what? Even with all that financial engineering and questionable accounting, the whitelist actually worked for its real purpose. By the end of 2025, more than 7.5 million homes that had been sitting half-built finally got completed and families could move in. That mattered enormously because angry homebuyers had started organizing mortgage boycotts, basically saying, if you won't finish my apartment, I'm not going to pay the loan. And if that movement had spread, it could have taken down the entire banking system. So getting those homes done wasn't really about real estate economics. It was about preventing the country from exploding. Meanwhile, though, the property collapse was creating this other massive crisis that threatened the whole government structure. Local officials across China had been funding their shiny new subway systems and airports and highways by selling land to developers, and then borrowing against future land sales through these special vehicles they had set up. When the property market imploded, land sales crashed 16% in 2024, and suddenly all that borrowed money had no revenue stream to pay it back. So Beijing went nuclear with the rescue in November of 2025, announcing a package of around 10 trillion yuan. That's $1.4 trillion. All aimed at preventing local governments from going bankrupt and creating a sovereign debt crisis. Local governments had built up this mountain of what they called hidden debt, basically loans they'd taken out off the books through those financial vehicles to dodge the official borrowing limits, and it had grown to over 14 trillion yuan. The disaster was that so much of this debt was short-term and expensive, with interest rates that were bleeding local budgets dry every month. The rescue package gave them 6 trillion yuan in new borrowing power spread over 3 years to essentially refinance all that toxic debt into official government bonds with way lower interest rates and way longer repayment periods. Then they threw another 4 trillion yuan on top of all that in special bonds, stretched out over 5 years. If everything worked according to plan, they would shrink that hidden debt pile from over 14 trillion down to barely 2 trillion by 2028. And the interest savings alone would free up something like 600 billion yuan for local governments to actually use instead of just paying debt services. But here's what you need to understand about what this really was. This wasn't stimulus. This wasn't money being pumped into the economy to get people spending or buying houses again. This was pure financial plumbing, moving debt from shady account vehicles onto official books, where regulators could see it and manage it properly. It stopped the immediate threat of systemic collapse, sure, but it didn't do anything to solve the actual problem, which is that nobody in China wants to buy property anymore, because they've watched prices fall for 3 years straight and they don't believe it's ever coming back. Consumer confidence has crashed to the high 80s when it used to be well above 120 during good times. People are terrified about losing their jobs, especially anyone in construction, real estate, or finance. So what are they doing? Saving everything. Household savings jumped to 160 trillion yuan by mid-2025. Up over 10% in just a year. Nobody's spending, which means businesses can't sell anything, which means they can't hire, which makes people save even more. This has pushed China into actual deflation. Prices have essentially stopped going up, and factory prices are falling outright. Once deflation takes hold, it's incredibly hard to break, because people just wait for things to get cheaper, which means less spending, which forces more price cuts, and the spiral keeps feeding on itself. The numbers tell the brutal truth. Real estate used to add multiple points to GDP growth every year, but now it's actively dragging growth down. The IMF estimates this collapse could be shaving a full 2 percentage points off of China's potential growth going forward. Beijing keeps targeting 5% growth, and they're pushing incredibly hard on electric vehicles, batteries, and solar panels to compensate. But you can't replace an industry that was a quarter of your entire economy with some export sectors. The math just doesn't work that way. The Chinese government is throwing billions at their property market problem, and it's barely making a dent. The numbers tell a pretty shocking story. China has rolled out mortgage rate cuts, lower down payments, better oversight of pre-sale funds, expanded credit lines for developers through something called a Whitelist, and the big one, a 300 billion yuan buyback facility to purchase unsold inventory. Sounds massive, right? But analysts who were saying recovery will begin soon, just a few months ago, have completely changed their tune. Now they're saying recovery remains elusive. Translation, yeah, this isn't working. So let's break down that 300 billion yuan buyback facility. It could, theoretically, purchase about 71.6 million square meters of unsold property, roughly 19% of all the empty inventory sitting across China. The problem? Even buying up just that portion would actually require about 7.3 trillion yuan if properties are sold at 50% discounts. That's 14 times more than what's been allocated. The support measures just don't match the size of the problem. But it gets worse. It's not just about how much money is available, it's about how much is actually being used. By September of 2025, only 5.3% of that 300 billion yuan facility had been touched, not even 6%. Back in 2023, a similar 100 billion yuan pilot program had a utilization rate of just 2%. When money sits there and nobody's using it, something is fundamentally broken. The real issue is that you can't fix demand with policy alone. Demographics are shifting. Fewer people actually need homes. Affordability is stretched to the limit, so even with better terms, people can't buy. And employment uncertainty means everyone's holding on to their money tightly. China's property market keeps sliding, not because the government isn't trying hard enough, but because these support measures are up against forces way bigger than any policy tweak can handle. Money alone won't solve this. You need people who actually want to buy and can afford to buy. Right now, China doesn't have enough of either. Unlike Japan, 3 things make China's situation different. First, Japan's bubble deflated after prices peaked, but China cut off credit while the market was already falling, triggering a sudden freeze. Japan dealt with overvalued assets, whereas China was left with millions of unfinished homes, turning a financial crisis into a collapse of public trust. And unlike Japan, China's economy is deeply tied to property, local government revenue, household wealth, banks, and jobs. So when real estate cracked, everything cracked with it. So China's property crisis isn't just about empty apartments and bankrupt developers anymore. It's become a full-blown economic transformation that's reshaping the world's second largest economy in real time. And the ripple effects are going to be felt globally for years to come. The question is whether they can find a new path forward before the whole system buckles under the weight of all this debt and deflation.